Good question. So what we're gonna do, geez. Okay, so what we're gonna do is focus on the other part of the profit equation. So we focused on revenue a lot with the whole elasticity thing. We talked about revenue and what revenue would look like depending on costs and quantities demanded at different costs or at different prices. And now we're gonna focus on the expense part of it. And we're gonna focus on production, the costs of production, how we break down those costs, things like that. So the first thing we're gonna do is we're gonna look at the profit equation. The profit equation is revenue minus cost equals profit. We're focusing on the cost piece, right? In calculating costs in an economics class, you're gonna look at things a little bit differently. You're going to look at two different categories of costs, one of them being very different than anything you would ever talk about in an accounting class, perhaps a management class. But explicit costs are the ones that you're going to be familiar with. They're going to be the ones that you talk about in your accounting class. An explicit cost is a physical cash cost. So things like paying wages, salaries, paying your rent or your mortgage, any of those supplies expenses that you're going to have. If you have insurance costs, all of that's going to be explicit. Those are costs that actually had a cash impact and you can record really nicely in an accounting journal. The second category of costs that we really only talk about in econ is going to be something we call implicit or implied costs. These are opportunity costs that sometimes we totally forget about when we are doing the profit calculation. A couple examples of these that we will be using in this class is the owner's time being one. If you own a small business, you probably spend 24/7 thinking about managing, making decisions about your company. You could be using that time to do something else productive in the market. Having another job, perhaps, right? Doing something totally different. That time has value, even though you don't really pay yourself a lot of times. You wait till the end of the year or whatever, figure out if there's any profit left for you. The other would be any sort of a capital asset owned by the firm, like a building. You can use the building for yourself, or you could rent it out, right? There's an opportunity cost involved. You using it yourself means that you can't use it for something else. There's an opportunity cost involved. And so those are costs that we are going to include from an economic perspective when we calculate profit. So alternative measures of profit. So this first one is accounting profit. This is the one that's going to feel and look a little bit more familiar to most of you. Revenue minus explicit costs, those actual cash costs, are going to be how you would calculate accounting profit. Economic profit, you would take the revenue and subtract all of the costs. Not only those explicit cash costs that we just talked about, but also those implied opportunity costs that we talked about. Economic profit is always going to be lower than accounting profit because we're subtracting that extra chunk of costs. Okay? From this point forward, if I say profit, I'm talking about economic profit. We don't really care about accounting profit here. It doesn't include everything we want it to include. Okay? And if I want you to calculate accounting profit specifically, I will tell you, because it's the outlier in this class, right? Normal profit is a little different. It's not necessarily a calculation as much as it's a condition. It won't make any sense to you until the next chapter, but it's something that we need to introduce. Your author's definition of normal profit is profit earned when all resources earn their opportunity costs. That's very wordy and it's very hard to explain right now. If I were you, what I would put next to that is when economic profit equals 0 is when you are experiencing this condition, the condition of normal profit. And that's where I would leave it for now. And we'll come back around to it. Any questions about any of that? Okay, let's go through an example, just so you can sort of see how the numbers play out. So here, let me give you a little background. This is the example from your book. The background here is that you have a woman, Wanda, who quit her job. She was making 50 grand a year at that job in order to start the Wheeler Dealer Corporation. She runs it out of her garage. She used to rent that garage to her neighbor to store his boat for $100 a month, but she kicked him out and she's now using it to run her business. She also had money in a savings investment account that she pulled out to start her business. She estimates she's losing about $1,000 in interest that she could have earned had she left the money in the account. Since she took it out, she now loses that interest. She has two explicit costs. She pays an assistant $21,000 a year, and she has material and equipment expenses of $20,000 a year. We're just keeping it super simple here. So if we wanted to calculate her accounting profit, we would take the 105, we would subtract the 21 and the 20, which are the explicit costs, to give us an accounting profit of $64,000. If we wanted to calculate the economic profit, we would need to then continue, right? We would need to take her implicit costs or her opportunity costs and subtract them as well. So we could just then subtract them from the accounting profit. And the 50 is the foregone salary, the salary she walked away from, $1,000 interest on that savings she took out, and a total of $1,200 a year in rental income that she walked away from because she started a business and ran it out of her garage. So if we then continued and subtracted these three things, we would have come up with an economic profit of $11,800. You will frequently see situations, maybe not you personally, I'm just saying in general, where an accountant would walk into a boardroom and say, guys, you guys are doing great. You're making a great profit. Everything's good. It's a positive profit, yada, yada, yada. An economist could follow in behind them and say, you guys are doing terribly. You're losing money. You should shut down. Because of this difference of these implicit costs. It would be possible, let's say Wanda walked away from an $80,000 a year job, right? And this was $80,000 in here, where we did this calculation and this was actually a negative economic profit. It happens all the time that we end up with a positive accounting and a negative economic profit. That if this were negative, if she walked away from an $80,000 a year job, what I would say to her looking at this, I would say, Wanda, shut up shop, liquidate everything, put any money you make back into your savings account, re-rent out your garage, and go see if you can get your job back. If that were negative. Now, in this example, it actually does end up being positive. Her economic profit. So I say, Wanda, keep doing what you're doing, because not only have you covered your expenses, but you've actually made up for all of those implicit or opportunity costs that you walked away from. Okay? All right. I think economic profit is a much better overall picture of all of the decision making that has happened for that business. Okay? Accountants don't care about any of this stuff down here. There's not a ledger out there they're going to record that in, right? The salary you walked away from, the foregone interest, or the foregone garage rental. You can bet you're going to have to do something like this on an exam, but I'm not going to split up these costs for you. I'm just going to give you a list and I'm going to tell you to calculate accounting profit. And you're going to have to decide what's explicit and what's implicit. Right? Look at the wording of all of those implicit costs. Foregone, foregone, foregone. That's not how you would look at a regular expense, a regular cost. Let's talk about something foregone. Now, I'm not saying I'm going to use the exact word foregone, but I might say like lost rental income, or, you know, the salary from her old job, there would be some wording that would indicate that that wasn't just a regular expense, a regular cost, okay? All right, so let's switch gears to production and resources. Okay, production in the short run, we would have two different types of resources. These resources then generate costs or expenses, and so we'll get to that, but we have to start out by looking at the resources. The different types of resources that go into production when you're thinking about profit and costs and things can be separated into two basic categories, and it's your variable resources and your fixed resources. Variable resources are just that. They're resources that are going to vary. Why are they going to vary? Well, if you produce more of something, you're going to need more of it, of those resources. If you produce less of something, of your final good or service, you're going to need less of that resource. Your fixed resources are a little different. These are usually your capital resources. These are things that it's pretty difficult to change, at least in some short run duration period of time. What is going to be a good example of a fixed resource for most firms, companies, production facilities?
The 10-year lease on the building.
The 10-year lease on the building. What else?
The bulldozer they bought.
The, $500,000 bulldozer you just bought, right? Those are things that whether you produce 0 of something or 1 million of something, those things are going to stay pretty much the same, right? You got it. You can't make your bulldozer bigger without buying a whole nother bulldozer. You can't really make your building bigger without adding on to it. And that all takes time, right? So cannot be altered easily in the short run.
So is that pretty much just like assets of a company?
Yeah, so assets of the company. Now, there's lots of different kinds of assets, right? But we're talking about usually a capital asset. So your capital, these are big purchases. These are hard things to change, okay? Variable resources, we're talking about a truckload of lumber. We're talking about an additional employee. Those things are pretty easy to alter in the short run. Speaking of short run, the short run, long run conversation in economics is big. Things are very different tomorrow than they're going to be next year, than they're going to be 10 years from now. We know in economics, right, all of these conditions change with time. And so our definition of short run, there are lots of definitions of short runs depending on the discipline that you're in. But our definition of short run is you have at least one fixed resource. You have one resource that's hard to change, right? In the long run, which is really your planning horizon, right? It's really what you plan for the long run and you operate in the short run. In the long run, you have no fixed resource. So if we're talking about that lease, that 1-year lease, that 5-year lease, whatever, your short run is that period of time, if that's your big fixed resource. So this can vary wildly, this short run time period. It can vary wildly depending on what kind of industry you're in, what kind of business you're running, what kind of market you're in. If you're doing consulting out of your house, your short run's super short. Because what's your fixed resource? Your desk, your spare bedroom? I mean, I don't really even know, right? Those are things that can be altered pretty quickly, right? If you need more space or something. If we're talking about being in the nuclear power industry, this is a totally different conversation because a nuclear power plant takes 10 years to build start to finish. So your short run is 10 years. Then 10 years from now, you could have a different nuclear power plant. So varies wildly, right? All right, a few definitions before we move into our sort of hardcore production numbers. Total product. I don't know why we use the word product, but we do. It just means total production. It's the same as saying total production. So it's how many units of output do you have? but a lot of times we say product instead of production for whatever reason. Production function is simply the relationship between your resource usage and the output on the other end. We know there's a direct relationship between using resources and producing goods and services, right? They're both typically moving in the same direction. But it's whatever that relationship is. Like, for example, if I employ one more person, I generally get 10 more units of production or whatever, right? But it's that relationship. In this class, there are no more important calculations and numbers than your marginal numbers. In this class, really the reason we calculate totals is to see how the totals change so we can derive the marginal numbers from those totals. Remember that marginal means a change, an additional amount, an incremental amount, right? It's some sort of a change. And so marginal product, because these are just production numbers or definitions we're running here, the change in total product when the use of a particular resource increases by 1 unit is our marginal product. So for example, I hire one more person. How much does that person give me in production? Every single unit of a resource you employ could theoretically give you a different marginal product. Not every single person you're going to hire is going to give you the same exact output, even though there's still an 8-hour workday. As a resource coming in, on the other end, how much that resource is producing for you, you could get totally different numbers, right? And same for every truckload of lumber. They're not going to necessarily be created equal, okay? So understanding your marginal numbers is very, very important if you're interested in profit maximization. Okay, so this takes us to a couple of concepts when it comes to this marginal production, because we see some phenomenon happen with marginal production. And the first thing we're going to talk about is something called increasing marginal returns. It sounds like exactly what it is. Increasing change in returns. So here we're still talking about resources because we're talking about productivity. You experience increasing marginal returns when the marginal product or the additional production you're getting out of employing more and more units of your variable resource goes up. I'm going to show you an example and you're going to understand what I'm talking about, okay? And this happens for a particular reason. You hire worker number 1 to do an entire task start to finish, they're going to be able to produce X number of units. You give them another person, they can start to create some separation of duties, they can start to create some efficiency, they can start to sort of get a small assembly line going, and they can produce some efficiencies. You give them worker number 3, they can do that even better. Number 4, number 5, number 6, to a point, okay? And I'm gonna explain to you why this happens. And then at some point, things are gonna shift. And the law of diminishing marginal returns is gonna kick in. This happens for a very specific reason. It has to do with your fixed resource. But the law of diminishing marginal return kicks in when you add more and more of your variable resource and the marginal product or the additional production you begin to see actually starts to shrink and perhaps can even go negative. Most companies experience both of these things, right? In the beginning, I employ more and more and more of a resource, my marginal product rises, I hit a plateau, I experience the law of diminishing marginal returns, and as I employ more and more of the product, it begins to decline and even become negative. I'm going to do an example for you here on the board. I'm going to stop sharing my screen really quick so that I show up larger for those of you at home. Okay? So here's my example. All right? So I own a pizza restaurant. This is my restaurant. This is my kitchen. My kitchen has a couple of ovens in it. Okay? Here are my tables. Spaced 6 feet apart, right? Okay. So I have a fixed resource that is my restaurant. I own it, right? I'm paying the mortgage payments on it. And I need a cook. They're going to be my employees or my cooks. So when I have 0 employees, I have total product of 0. 0 employees produce 0 pizzas. I get cook number 1 in my pizza restaurant. And cook number 1 gives me total product of 50 pizzas. The marginal product of cook number 1 is the change in my total product by adding that resource. Okay? So my marginal product for worker number 1 is 50. That was the change they created. How many cooks are usually in a pizza kitchen?
3.
Yeah, 3 is a good number, right? I usually say like 3 to 5, right? Is probably what you would typically see, okay? So I add cook number 2. There's a reason there's 3 to 5, right? There's a really good reason. So I add cook number 2. So cook number 1's in there. I've added cook number 2. Together, they make 150 pizzas. Not because cook number 2 is so amazing, but because together they're amazing, right? And so my total product when I have 2 cooks is 150, which means the marginal product of cook number 2 is 100. Not because they're special, right? But because they add to the overall efficiency of the operation. Then I add cook number 3. And together, the 3 of them make 300 pizzas. The marginal product of cook number 3 is 150. I am seeing increasing marginal returns as I add more and more of my variable resource to my production. So far, so good? Okay. So cook number 4 comes in. I have a small kitchen, right? So I now have 3 cooks. I have a small kitchen. I add cook number 4, and total pizzas goes to 400. Marginal product for cook number 4 is 100. Okay? My marginal product is now beginning to decrease. I sort of hit that plateau, that peak, all right? So now I went from having increasing marginal returns with each unit of my variable resource to seeing diminishing marginal returns. This will continue typically, okay? So I add cook number 5, so now I have 4 cooks. I add cook number 5, I now make 450 pizzas. So the marginal's 50. These are still positive numbers. I'm not saying I don't want these cooks, right? That cook is still adding 100 pizzas or 50 pizzas to my production. It's just that the marginal is beginning to go down. I'm not gaining quite the strides in efficiency, okay? If I were to keep going, is there a problem with adding more cooks to this kitchen? Absolutely. The problem is I can't expand my kitchen in the short run. It is my fixed resource that is binding me. And there is going to become a point where I add cook number 20, right? Probably way before cook number 20. I bet it happens at cook number 8, right? Where I'm going to actually see a negative when it comes to the number of pizzas I'm producing. I'm actually going to produce less pizzas by putting that additional cook in my kitchen, right? Because they're all standing there like this, right? Trying to figure out how to make pizzas. Doesn't make sense. That's why there's an optimal range of pizza cooks in a pizza kitchen. Okay? And somebody wouldn't have to sit down and run all the numbers to figure that out, right? They would figure it out. Okay. So let's go back to sharing. But those are your concepts. All right. So this is the example from your book. This is just like my pizza kitchen example, okay? The example from your book is a moving company. I think it's called like the Smoother Mover Company or something like that. Their fixed resource is a moving truck. They have one moving truck. That's their only fixed resource, is that truck, okay? And they have one, and only one. Their variable resource is the workers. Now, in a normal operation, you're gonna have lots of fixed resources and lots of variable resources and all of that. We're just keeping it super simple, which we'll really always do, as simple as possible. You can see here, these are the number of movers I can employ, 0 through 8. 0 workers gives me 0 tons moved per day. 1 worker gives me 2 tons moved per day. 2 workers, 5 tons, so on and so forth, okay? Here's the marginal product, or the change, which is the same as like the change in the pizzas. You can see that we have increasing marginal returns, 2, 3, 4. Then we see the law of diminishing marginal returns kick in, 3, 2, 1, 0, and it even goes negative. You can see it follows the law that we expect it to. Most operations are going to. Now, looking at this, I can already tell you, I don't know what my expenses are. I don't know what my revenue is. I don't know what any of that is. I can already tell you I don't want movers 7 and 8, right? I can already tell you that that's worthless to me. Not because they're worthless, but because I have one truck. The reason I probably went negative here is because I probably had to make multiple trips, not moving furniture, moving my workers, right? That erodes efficiency. When you're moving people, your resource, and not moving furniture, which is your final service, okay? It is that truck and that one truck that caused this to happen. Just like it is my pizza kitchen that actually was the driver behind all of that happening, okay? That negative, that diminishing marginal return. Okay. This is just the graphs of the stuff you just saw. This is not new information. This is just me showing you a visual of that information. So you can see total product moved per day, and then this is the number of workers here along the bottom. You can see that it began to rise. We knew it did, and it rose significantly. And then it still rose, but slowed down, right? The increases diminished. Then we plateaued out and basically got no additional production out of worker number 7. And then worker number 8 actually brought total product down. So you can see, just like we talked about, we saw increasing marginal returns till we hit 3 workers. Then we saw diminishing, but still positive, returns until we got to worker number 7, who gave us no additional production, and then worker number 8, who took us negative. Not new information, just a new way to look at it. All right. So we've talked about resources, we talked about production, changes in production. Now let's switch to costs. So we've now lumped our implicit and our explicit costs together, right? They're now just in a pool. And now we're gonna separate them again into fixed costs and variable costs. Chances are fixed costs go with fixed resources and variable costs go with variable resources, for the most part. Okay, I wouldn't say it's 100% true, but for our purpose, it's probably a good assumption to make. So your fixed cost, so here we're talking about your rent, your mortgage, right? Equipment, things like that. Those are costs that do not change with output. Whether you produce 0 units of something out of your factory or 1,000,000 units of something out of your factory, it actually doesn't matter. That cost, that rent, that mortgage, equipment payments, whatever, that's all going to remain the same. Okay? Variable costs are going to be those costs that do fluctuate with output. So I need another truck of lumber if I'm going to produce more toothpicks, right? Or I need another worker if I'm going to run another machine. Like, that's variable. There's a direct relationship, okay? It's really important to distinguish between the two, because when it comes to profitability, there's not much you can do about your fixed costs, at least in the short run, right? You've locked yourself in. There's nothing you can change about your rent if you've signed a lease for a year. Nothing you do. But those variable costs you can play with a little bit. Okay, so it's important to divide those into two very distinct categories. Okay, total cost and marginal cost in the short run. Total cost is fixed plus variable. That gives us total. We only separate them because we really need to for an analysis, but if we're coming up with total cost for some other reason, which we do, you just sum the two together. When output is 0, and you have no variable cost, that's what that would imply, your total cost is equal to your fixed. Your fixed you can't get rid of. Your variable you can. But to get rid of your variable, you have to produce less, right? Because if you produce more, your variable goes up. It's a direct correlation. Like I've said, marginal's the important information usually in microeconomics. It's micro. We're looking at little teeny pieces of information. And it actually is what helps us really get down to that unit of production that maximizes our profit. We actually want to get it down to the unit. If you produce 672 units, that's where you maximize profit. So we're getting down to the details now. Marginal cost is the change in total cost when you produce an additional unit. So we sort of did that with productivity. We calculated marginal, or the change in the total product. Now we're looking at the total cost and seeing what the change in the cost was. Many times it's difficult to get it down to a change in total cost for producing one singular unit. If you're producing paper clips, knowing how much each paper clip has increased your costs, your total cost, is actually not helpful information, right? It's too small of a product. If you're producing a Boeing 737 aircraft, you probably know exactly what each individual aircraft costs you specifically, okay? Those are two totally different things. But a lot of times when we increase a resource, we hire another person, they produce more than one unit for us a day. And so we have to do this little batch thing where we come up with marginal cost by doing this little batch calculation because we're producing something in a batch, right? We're producing 1,000,000 paper clips at a time. And so we have a batch of paper clips of 1,000,000. We don't really need the detailed information. But if you wanted it, what you could do is figure out what the change in total cost was for those units, for that batch of units, and divide it by the quantity in the batch if you wanted to get it down to the nitty-gritty. But you cannot track each paperclip. Now this goes for the tons moved too. Worker number 3 added, now I can't remember, 4 units of production or something. Well, 4 tons moved throughout a given course of a day. Like, I can't tell you that this specific ton cost this much to move. And then the second ton I moved cost, you just don't track information that way. But what I know is what the cost was for the day, and then we got that additional 4 tons, and I could do a little division to figure out essentially what those 4 tons moved that per day would cost me. Okay, so sometimes you have to break it down a little bit more by just doing a little simple division. Okay, all right, so check this out. This is tons moved per day. You've already seen it. Okay, 3 over here, column 3 is workers per day. You've already seen it, right? We didn't put 7 or 8 here because we knew we didn't want 7 or 8. I don't know if I want worker number 6 yet, but I know I don't want 7 or 8, okay? We have a fixed cost of $200 per day. Where did that fixed cost come from?
How much gas costs or whatever.
Yeah, it probably has something to do with truck expenses, right? Because that's our fixed asset, that's our fixed resource. So chances are that fixed cost goes with the truck, okay? Whether we're leasing the truck or whatever. Our variable cost there in column 4 probably goes with our variable resource. What's our variable resource?
The amount of workers.
It's our workers, right? So we have a fixed resource truck, our variable resource is workers. I can do the math here and figure out that it looks like we're paying people $100 per day. Because 1 worker cost me $100, 2 workers cost me $200, so on and so forth, okay? So then if I was calculating my total cost for all my resources, I would sum fixed plus variable gives me total. Okay, and so that's what I've done. Fixed plus variable gives me total all the way down. If I was going to calculate marginal cost, there's a little calculation up here if you need it, but it's that batch calculation where you didn't produce 1 unit of something that you can very specifically assign cost to. Instead, you've produced some and you need to break it down, okay? So this first worker who costs us $100, who increased total cost from $200 to $300, a $100 change in total cost, produced 2 units for us, 2 additional units above and beyond 0 workers. If I take that change in total cost, that's what the delta TC means, change in total cost. If I take the change in total cost, which was 100, and I divide it by the change in quantity, we went from 0 to 2, 100 divided by 2 gives me 50. Those 2 first units of production had a marginal cost of $50 a piece. About, right? Because we can't distinguish between unit or ton number 1 and ton number 2. It was probably 1 move, and yeah. So if we employ worker 2, they increase, that resource increases our total cost from $300 to $400, so again, $100. But our change in quantity went from 2 to 5, or 3 units. So the change in total cost was 100 divided by the change in quantity of 3 gave me 33.33. Again, worker number 3 increased our total cost by 100. It's actually 100 all the way down, right? But they contributed 4 units of production. That's the change. We went from 5 to 9 units moved. So 100 divided by 4 gives me 25. So on and so forth. This actually follows that trend of increasing returns and then diminishing returns. As you get more out of your resource, right? If you get more out of your resource, those big jumps in production drive down the cost of those units. If you hire 1 more person at $100 and they produce 150 more pizzas, those pizzas were cheap. These first pizzas were more expensive, but your pizzas got cheap cheap, 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 and then began to get more expensive again, okay? Doesn't mean you don't want to produce the first pizzas or the last pizzas. It's that the pizzas in the middle are usually the cheapest pizzas you're producing. Just like this tonnage, right? The cheapest tons we produce are when we're seeing the greatest increase in marginal production, because we're employing one more unit of a resource who's giving us a lot more in return than the other units of that resource did. Okay? Any questions about that? Okay, I talked faster than I thought I was going to. So this is actually where I want to stop today. Any questions about this? Where I got any of these numbers? Marginal cost is actually one of the most important factors when we try and determine profit maximization. That's why it's super important that you understand how to calculate marginal cost. I will likely make you do this on an exam. Yep.
So is it possible to have the same marginal costs at different fixed costs, or no, variable costs? Like if you had a.
Yeah, and you can see it up there, right?
Oh, yeah.
Yeah, so there's two. So his question was it possible to see the same marginal cost at like different, totally different places, units of production, resources? Absolutely. Because what we know is that marginal cost will go down and then it will come back up, okay? And it's a direct result of this going up and then coming back down, okay? Because we're getting more out of our resources, which drives the cost low, okay? So they kind of have an inverse relationship, these two different things. But it's this that drives that, yep. So a lot of numbers will double back to, right? Could potentially be the same as it falls and then rises again. Good. Any questions from those of you at home?